This is Business Day TV and you're watching our MPC special. My name is Ndaoleng Lechela. Now, the MPC is set to deliver its policy decision today. Economists are divided between an interest rate hold and a cut, as this one comes at a time where uncertainty lingers in global markets. In March, the central bank paused the cutting cycle for the first time after 3 consecutive cuts. And joining me for a preview of today's decision is Annabel Bishop, Chief Economist at Investec, and Johann Els, Chief Economist at Old Mutual. Johann, Annabel, thanks so much for your time this afternoon. Now, we have another meeting where economists are, of course, divided, looking at inflation. One may say it's obvious, but we have to, of course, keep in mind those global risks that the SARB is assessing. With that being said, what are your expectations? I'll start with you, Annabel.
Yes, hi. Look, I think the consensus and the financial markets are leaning on the side of an interest rate cut today, a 25 basis point cut. I think it's quite wide in terms of expectations, and of course the bond market is also expecting an interest rate cut as well. Historically, when the FRA curve, the forward rate agreement curve in the markets, does factor in an interest rate cut, the Reserve Bank has tended to move. So I think, you know, the debate has really been, will the Reserve Bank cut, given that the change in inflation targets has said to be imminent, and obviously is likely to revise the inflation target down lower. And therefore, given that their forecasts were 4.5% for the medium term, does this actually mean that then maybe they'll be careful and not cut, or does it mean they'd like to squeeze a cut in quickly before this happens?
I'd like to think that they might want to squeeze in a cut before that inflation target changes. What are your thoughts, Johann? Surely there is some wiggle room looking at where headline inflation is at, right below that 3 to 6% target.
Absolutely, and I think it's always this argument what we think they should do versus what they actually will do. I think they should cut rates given the trajectory of inflation over the last few months, surprising mostly on the downside. Core inflation now at 3%, so excluding those volatile food and energy categories. And with consumer goods inflation, the weighted average of clothing, footwear, furniture, appliances and vehicles at just 1.2%. So there's virtually no inflationary pressures. We will likely see the Reserve Bank revising their short-term forecast lower once again. So absolutely, I believe they should cut rates. The rand is stronger, the global risks have eased since the last meeting. And then, as Annabel said, it depends on how they view the global risks at present. I believe they lower, but how soon, how close are we to the lower inflation target? I still think that we're not that close, that it'll come later this year or early next year. And I'm hoping that there will be some phased in approach, because we haven't yet got full political buy-in for a lower target. In other words, administered price increases are still set substantially above the present target. And then we're not even talking about a potential lower target. I think there's a window of opportunity, and I strongly believe they should take that window of opportunity this afternoon.
All right, you mentioned there is a window of opportunity with those renewed, talks around the inflation targeting and lowering the inflation target. Do you not perhaps think that they could factor that into today's decision, Johann?
That is possible, that they already start thinking about that. We, of course, do not know what's happening behind the scenes in terms of the discussions ongoing between Treasury and the Reserve Bank and the technical teams working on the lower, potentially, inflation target. We don't know the timing yet. I believe that they should not yet factor that in until it's clear out there in the market what the new target is, what is the time frame, etc. I think at present we should expect our central bank to act and react on the present target and the present inflation numbers.
And the timing of this move has been highly debated, Annabel, considering that we are still seeing, households under pressure. What are your thoughts around that inflation framework?
Yes, so I think think, when the Reserve Bank does its inflation targeting, it's key to note that they actually are forward-looking in their approach. So they look for a 6 to 24-month period. And of course, while inflation is very low, below the current band of the inflation target, it's historical. It's for the last few months. But it's important still because it creates a low base from where we move off from. But key, the Reserve Bank has said that it particularly targets inflation in a 12 to 18-month period. Be that as it may, it also sets the inflation target itself as well. Sorry, not the inflation target, the inflation forecasts as well.
Yes.
The National Treasury sets the inflation target. So, of course, with it setting its own inflation forecasts, you can see that it's quite important, what the outlook really is. So, the inflation environment has been incredibly mild. There's not much reason to expect inflationary pressures to rise. Instead, what we're going to have as we reach the end of the year is base effects coming through from inflation of last year, the lower inflation the second half of last year. So all of this really points to the fact that inflationary pressures themselves will be quite muted. Now, I think what's quite key is that inflation has been surprising on the downside, especially for the Reserve Bank over the course of this year, which gives strong cause for the Reserve Bank to revise down its inflation targets. So we think today they could come out, sorry, not the inflation targets, I keep saying that, the inflation forecast. It gives it good cause to actually look to revise its inflation forecasts when they come out today. And I think that's quite key, given that they're at 4.5%, which would really indicate, given their quarterly projection model, they might have one more 25 basis point cut in the system. But obviously, if it's revised down, perhaps closer to 4%, there could be room for 2 interest rate cuts, again, depending on when this inflation target change is finally announced. But I think it's really key to note that there just aren't any demand price pressures in the economy. And that really means that, going forwards, inflation might surprise on the downside again. Again, also bringing down the Reserve Bank's inflation forecasts.
Are there no concerns around, the fuel levy increase that's coming into effect next month and the impact that could have on inflation, or is it just something that's seen as once off, Annabel?
So you do make a good point. Of course, the fuel levy changes are important for inflation. They're quite modest, though. They're not very large. They're inflation adjustments. But also, of course, as well, key is the fact that obviously we do find ourselves in a situation where global oil prices have fallen substantially. And in fact, even the rand's a bit stronger against the US dollar itself, coming on the back of comments made from President Trump in the United States that he would like a weaker US dollar, and of course, as well, weaker oil prices. So this would actually feed into being supportive of more moderation in inflation pressures going forward. But obviously there are some increases also coming through from the budget as well in terms of the sin taxes, and that of course is food and alcohol, tobacco. All of those are quite key. I think we do tend to have them every year, but a little bit later this year. But again, not exceptionally large increases that are going to derail the inflation outlook.
All right, inflation aside, there's also been mention of the global uncertainties and how the SARB has been navigating that, especially as we are, a small open economy and are likely to be impacted by really big tariff moves. Are we perhaps not overestimating the impact of these trade policies, Johann, considering what's played out since the March meeting, looking into even the latest move where we saw a federal court blocking President Trump's tariffs?
Perhaps. I think there's still lots of risks around, but I would agree that the risks have eased quite substantially since the March meeting, and even more since the first week of April when we had the announcements of Liberation Day tariffs. The fact that at least the South African delegation going to the White House have started trade negotiations is also fairly important, even though there's no specific deal. The US administration has clearly said that if you start the negotiation process, then at least we won't go back to those punitive tariffs that was announced, and 31% for South Africa, for instance. At the moment, we're still subject to the 10%. But the fact that there's some issues around the viability and the longevity of this trade war suggests that perhaps the risks are starting to ease a bit. Plus, the impact of those uncertainties of US policies on the US economy itself probably means a weaker US economic growth environment towards later this year. That will likely limit any type of inflationary uptick, so at least the second round inflationary pressures might be weaker than what we previously expected. The Fed will likely start cutting rates again as the US economy weakens. The dollar weakness will likely continue. And all of that is good for the rand exchange rate. So perhaps a more stable rand at a time when oil prices have been lowering steadily since early this year. So all of that is supportive of a lower inflation environment. Plus the fact that also on the fuel levy increase in June, on the back of an over-recovery on the petrol price at the moment. So there won't be an increase in petrol prices in June, just a somewhat lower decrease in the petrol price. So I agree. The environment is pretty deflationary at the moment, even though, as Annabel said earlier, there's going to be a slight upward trend towards later this year. I think it's going to be a very muted upward trend, and we'll probably see the Reserve Bank agreeing when they come out with their forecasts this afternoon.
You touch on the rand, and that was going to be part of my next question. It's really been intriguing to see the rand strengthen over the past 2 weeks. We've seen it strengthen below that 18 rand mark to the dollar. This, of course, as we've had, some dollar weakness coming through. And it's also been interesting to see what's been playing out on the dollar front, because it is expected that when you see tariffs, you're going to see a stronger dollar. Now, Annabel, there's been debates around the dollar losing its safe haven appeal in these uncertain times. What's your reading around that?
Yes, I think it's an important point to unpack. The ultimate safe haven, as we always know, for financial markets is gold. And of course, gold has seen some gains. Nevertheless, US Treasuries have also been key as a safe haven asset. Now, of course, there have been worries this year, and there's been huge financial market volatility and uncertainty around the fact of what exactly is really going to happen in terms of the tariffs, US economic growth, and even the impact on US inflation. And of course, we have seen the Liberation Day tariffs implemented, then rolled back. We've seen pauses. The same has actually happened the first quarter, when we obviously experienced a lot of foreign policy tariffs being imposed on countries, and then many of them rolled back. Key, as Johann said, is negotiations. If we move into negotiations, if countries around the world move into negotiations with the US, there's much likely chance of less tariffs. And that's also absolutely key when we look at the US and China, which had the worst tariff increases, you recall, over 100%. Now, a recent meeting in Switzerland has seen that this could well drop substantially and really return to much, much lower levels of tariffs. So overall, the rand itself has seen strength against the dollar, but not against the euro and the pound. And, this is really peculiar to the fact that the United States has seen its dollar weaken substantially. So it's partly reflective of the uncertainty in financial markets, specifically in the US, worries about growth, worries about perhaps equity growth, there are other aspects. But also, of course, as well, we mustn't forget that President Trump has a lot of sway in global markets, talking the dollar down. And I think people might also be a bit worried about the translation risk if they invest in assets in the US, such as treasuries, and then you see depreciation of the US dollar. That could also impact the investment as well. So I think many factors feeding into this.
And what have you made of what's been playing out in the US, particularly when it comes to the dollar, Johann, and, the conversation around its appeal as a safe haven? All right, it seems like Governor Lesetja Kganyago is taking to the podium, so we'll hit pause on the conversation and get your reactions once he is done. And that's where we leave it for now. That was Investec's Chief Economist, Annabel Bishop, and Old Mutual's Chief Economist, Johann Els. So we cross over now to SARB Governor Lesetja Kganyago.